If you've been thinking about a portfolio checkup, but would like to know more about what is included in these sessions, that's reasonable. Just ask for our checkup checklist. It shows you what Steve covers in the checkup and what documents are useful to gather up. Just call 888-99-CHART. That's 888-992-4278. Or if you're there at the computer, just go to investtalk.com and click on Contact Us, and then just tell us that you want the checklist, and we'll send it to you by email. Or if you'd like a copy of Steve's special report called Supercharging Your Portfolio, call the same number. That's 888-99-CHART. And thanks for listening to our podcast. This is Invest Talk. Answers to questions about maximizing invested dollars. Invest Talk is made possible by Klein Pavlis Peasley Financial, serving those who want to make the most of the money they make. We're glad you're with us today for this special program we call The Big Questions, the questions most often asked by our callers over the years. In the next hour, financial advisors Jerry Klein and Steve Peasley will combine their more than 60 years' experience to answer these most often asked questions, defining important investment terms and principles that are vital to being a responsible investor in today's active investment marketplace. Let's begin with the most fundamental of all questions. Who should invest in the stock market and who shouldn't?
I'll tell you what, those people who are over 50 that haven't paid off their mortgage shouldn't be investing in the stock market.
No, you really, if you're over 50 years old and you still have a mortgage, you need to use the assets that you gleaned to pay off your mortgage. Give them the economics of that.
Well, think about it. You're 50 years old. How many more years you got for earning power? How much on that house? People don't look at the house as an asset. It is an asset. But you know what? You're getting less and less years. You have less and less years to earn money. And at 50, from 50 to 65, that money should start being put away for your retirement.
Well,
years.
I think more importantly, Steve, if you look at the mortgage issue, let's say you got a 5% mortgage or a 6% mortgage.
Right.
You realistically have to earn, if you're still working, you've got to earn around 40 to 50% above that. So let's say you're doing a 5% mortgage. You got to earn 10% of your money, and in today's reality, you're not going to earn 10% of your money.
And your write-off is pretty minuscule. I know everybody argues a write-off on that, but it's pretty minuscule. Remember, you got to earn that money.
All right, let me deal with the write-off, okay? Because it's $35,000 worth. Let's say 30% of 5%. Is 1.5%. So you got a 3.5% cost of the mortgage. You still have to earn 7% of the money. With Treasury, if a 10-year Treasury is paying 4.25%, you can't even come close to that number.
Yeah. So if the question is who should invest in the stock market? Those people that have the assets to invest in the stock market and don't have credit card debt, they paid off their mortgage, and have money to invest in the stock market.
Okay.
That's simple as that.
Right.
Is it true that the stock market is the best long-term investment available historically?
Well, the stock market over the last 75, 100 years will return to you with dividends about 10% of a year. Now, when you talk about long-term, you have to decide what long-term means to you or me. What does long-term? Some people think long-term is a year. Well, that is no way near.
No, that a year is not
some people think that. How about the person we spoke to today?
That's true.
She thought 6 months was a long term.
That's true. She just right. She just wanted to. I don't know.
So you have to define long term. To us, long term is 10 years or longer. To me, I don't know about you, Jerry.
Well, 10 years or longer. But what happens if you define your long term as a year? You can't really say that it's long term.
Then you can't be in the market.
Right, because
simple as that.
And you've got your stock selection's got to be different. You can't buy these medical research stocks that are losing money for 10 years in a row that really don't have a product yet.
Yeah.
You can't do that.
No.
Because unless you have the three elements that make up the what's important What is important?
Well,
what are the three elements?
Well, that's the next questions.
Okay.
Okay.
But the bottom line is you got to have a proper grounding on what you're looking for out of your stocks. I mean, yes, you can go long term in stocks like General Electric and expect Walmart and Home Depot, but General Widgets and things like that, no, sir.
No.
You can't do it.
Yeah.
We hear people being asked as they begin to consider organizing an investment program, are you a conservative investor or are you more able and willing to take risks? What is the risk level that you can tolerate? How does one measure their capacity for risk?
Well, go ahead and answer that one, Steve.
Well,
because you had one first-hand knowledge of that before you and I got together.
Yes. You know what? If you are having trouble sleeping, at night, then you have too much risk. You need to reduce your risk, go to something more safe. Jerry calls it the sleep quotient. If you can sleep at night, be very comfortable with what you have, then you're not you personally are not taking too much risk.
I think, to make the risk level a reasonable risk level, if people will adopt the attitude that you don't put more than 3 or 4% in any one stock.
Right.
I think that really, because let's face it, if you lost, let's say that you're going to lose 3%, you lose the whole 100% of 3%. It only affects your portfolio by 0.3%.
Yeah, that goes back to the old saying: don't put all your eggs in one basket.
Right.
So spread it around.
Yeah, but then there's guys that'll say, put your eggs all in one basket and watch the basket.
Yeah, but you know what? If you buy 1 or 2 stocks, Jerry, look at Enron. You never know. That's the 8th largest company in the United States, and it still went under.
But we knew.
Well, we kind of knew, but
we didn't know from inside information. We only knew because we looked at a chart, knew how to read a chart,
and it didn't look.
The average investor doesn't understand that.
I know. So it's your own sleep quotient. That's how much capacity of risk you can take.
How do you reduce the risk in this risky business of investing? In other words, what's the secret to a good night's sleep?
You've got to gauge the risk. Now, how do you gauge the risk? Well, let's say that you got a stock that's been going up for 6 months, and the stock is at the 20-day moving average, and
so when you're trying to measure risk, determine how high above the 200-day moving average it is. And if it's very, very high above the 200-day moving average, the higher it is, the more risk you'll see in the stock. So that's one way to measure risk. Another way, more basic way, is if the stock does not have earnings, and you buy it, now you got a whole different. Look how risky you're taking.
Well, now you really have risk because now you have a company that is really, in theory, not even in business.
That's right. You're burning money. So why would you buy that? That's very risky.
Well, you'd buy it because you can identify the fact that the stock earnings are going to turn around, and so now you gauge the turnaround earnings in that stock.
But if you can't do that, and most people can't,
that's true,
then you shouldn't be buying that stock.
No. And of course, the other thing, Warren Buffett is a genius at this. If you don't understand what the company does,
right,
in 30 seconds or less, don't buy the stock.
Yeah, those are all risk gauges of risk. We just gave you 3 or 4 of them.
Technical Analysis of Stocks and Trends, 8th edition. Well, this may not be the book you'll take with you on your vacation, but it is one of the books Jerry and Steve recommend to be on your shelf if you're serious about doing